you have almost certainly been told that Enron was a company that lied about its profits. That is true. It is also very close to the least useful thing anybody ever says about it. Because the profits Enron reported were not invented in a back room at midnight. They were calculated, they were signed off, they were filed with a regulator and audited by one of the largest accounting firms on earth. On the 30th of January 1992, the Securities and Exchange Commission told Enron that it would not object to the accounting method that made every bit of it possible. Not a loophole. Somebody found in the small hours. A method. A regulator looked at and declined to stop. In the next half hour, I am going to show you the two specific moves at the center of this, and by the end you will be able to find both of them in any set of company accounts you are handed. Because neither move stopped being legal in 2001. Both are still there in the rules today. Somebody is using them this quarter. Start with what Enron actually was, because almost nobody remembers, and the whole story is unreadable without it. It was a pipeline company, steel in the ground, gas moving through that steel from one place to another place, for money. In 1985, a company called Enron bid about $2.26 billion for Houston Natural Gas. The merger created the largest gas pipeline system in the United States, around 37,000 miles of pipe. 37,000 miles. That is a real thing in the world. You could walk the length of it, you could dig it up and weigh it. For 9 months, the merged company was called HNG/Enron, which is not a name anybody was ever going to keep. In April 1986, it was renamed Enron. And for the first few years, it did the unglamorous thing. It moved gas from where the gas was to where the gas was wanted, and it charged for the moving. A pipeline is a wonderful business in one very specific way. It is extraordinarily hard to argue about what it is worth. There is a pipe. The pipe has a length. Gas went through it, and a measurable volume came out the other end, and somebody paid for that volume. Every part of that can be counted by a stranger who does not trust you, which is the only kind of counting that finally matters. Hold on to that sentence, because everything that happens for the next 15 years is a story about moving further and further away from things a stranger can count. The trouble with owning a pipeline is that it is also extremely boring to own. The returns are steady, the growth is slow. Nobody has ever put a magazine cover on a company that moved 4% more gas than it did last year. And in the late 1980s, Enron was about to be handed an idea that was not boring at all, an idea that was genuinely clever. Which is the part of this story most people skip, and skipping it is why the rest never quite makes sense. In 1989, Enron created something it called the gas bank. The concept came from a consultant at McKinsey & Company who was working with the firm. His name was Jeff Skilling. Here's the problem the gas bank was built to solve. And I want to be fair about it, because it was a real problem that real businesses actually had. A gas producer needs to know what it is going to be paid next year, because it has to decide today whether to drill. A gas fire, a factory, a power station, a chemical works needs to know what it is going to pay next year, because it has to decide today whether to build. And neither of them can possibly know, because the price of gas moves every single day, and it moves a lot. So Enron walked into the middle of that. It would buy gas from producers on long contracts at agreed prices and sell gas to buyers on long contracts at agreed prices. Both sides got the one thing they could not get anywhere else: certainty. Enron kept the difference and carried the risk that the price would move against it. That is a bank. That is not a figure of speech, it is what the name is telling you. Enron was borrowing and lending gas the way a bank borrows and lends money, and taking a margin for standing in the middle. And it worked. It genuinely worked, and it made money, and it solved something. Which matters. Because if Enron had been nothing but a fraud from the first day, no clever person would ever have gone to work there, and thousands of clever people did. It was not nothing but a fraud. It was a good idea that got welded to an accounting method it could not survive contact with. And that distinction is not me being generous. It is the reason the story is worth half an hour, because a company that was simply lying from day one teaches you nothing you did not already know. A company that was doing something genuinely useful and destroyed itself with the way it chose to count that useful thing teaches you something you can actually use. Every organization you will ever work for is somewhere on that same line. Because look at what happens the moment you become a bank. The thing you are selling stops being gas. What you are selling is a contract, a promise about a price. Years into the future. And a contract does not have a length in miles, and it does not have a volume. You can meter at the far end. A contract has a value, and a value, unlike a mile of steel, is fundamentally an opinion. Which brings us to the 30th of January, 1992. On that day, the Securities and Exchange Commission notified Enron that it would not object to Enron using mark-to-market accounting. Read that sentence again, slowly, because the exact wording matters and almost every retelling of this story gets it wrong. The regulator did not bless a fraud. The regulator was asked about a method, considered it, and declined to object to it. So, what is the method and why did it change everything? Ordinary accounting is historical. You bought a thing for £100, it sits on your books at £100. When you eventually sell it, you find out what it was really worth, and only then. Mark-to-market says, stop carrying it at what you paid. Carry it at what it is worth right now. And for something that trades on an open market every day, that is obviously the better answer. A share you bought at 10 that is trading at 40 is worth 40. Insisting it is worth 10 is the lie. So mark-to-market is not a trick, and I want to be clear about that. For an enormous range of assets, it is simply more honest than the alternative, and that is exactly why it exists. Now apply it to a 20-year contract to supply gas to a power station that has not been built yet, in a country you have never operated in. What is that contract worth today? Well, you estimate the cash it will throw off in each of those 20 years. You choose a discount rate. You bring all of that back to a single number in today's money, and you write the number down. And here is the move. That number, the whole of it, is income. Now, this quarter, not the cash. There is no cash. The cash, if it ever comes, arrives across 20 years. You have just booked 2 decades of imagined profit into a 3-month reporting period. It is entirely legal, and your auditor will sign it. Not because the auditor has been corrupted, because the auditor's job is to check that you applied the method correctly, and you did. That is the first of the 2 moves. Hold on to it. We will come back at the end and I will show you exactly where to go looking for it. Because notice what everything now depends on. It depends on the estimate. And the estimate is produced by the company whose reported earnings are the estimate. Nobody has to lie for that to go badly wrong. Ordinary optimism is entirely sufficient. Though, of course, the moment the estimate becomes the earnings, optimism stops being a personality trait and quietly becomes a job description. And a discount rate moved by 0.5 percentage point across 20 years is worth an enormous amount of profit, and it is a professional judgment, which means it is very hard for anybody outside to call it wrong. So think about what that method does to the inside of a company, day to day, to the people working in it. If profit is recognized when the deal is signed, then the thing the company rewards is signing deals. Not completing them, not delivering on them, not collecting the cash from them, signing them. A person who signs a 20-year contract on a Friday morning has produced this quarter's earnings by Friday afternoon and can be paid for it. Whether the plant ever gets built, whether the counterparty is still solvent in year 11, whether the price assumption survives the decade, those are problems for a later quarter and quite possibly for a different person entirely. And meanwhile, the pipeline, the 37,000 miles of steel that a stranger could walk along and verify, becomes the dull part of the company. The relative nobody wants to be seated next to at dinner. And that is not only a matter of status inside the building, it shows up in where the money goes. Capital, attention, and the best people move towards the part of the company that produces this quarter's reported earnings, and away from the part that merely produces cash. Over a decade, that is a very large amount of drift, and every single step of it looks rational from inside. So Enron went looking for more things to be a bank for, and it found plenty. Electricity, coal, steel, paper, water, bandwidth, weather. Yes, weather. If your business loses money in an unusually warm winter, Enron would sell you a contract that paid out in an unusually warm winter and you could budget again. Which is, once more, a real product solving a real problem. And that is precisely what made the whole thing so hard to see from outside. But every new market meant new contracts. Every new contract meant a new estimate. And every estimate landed in reported earnings on the day it was made. The company was, in a very precise and literal sense, running on its own opinion of the future. And an opinion about the future has one terrible property that a mile of steel does not. It can be revised. It can be revised. In late 1999, Enron launched Enron Online, a website. You went to it and you traded with Enron in gas, in power, in dozens of other things, at prices on a screen. It became the largest e-commerce site in the world. By 2001, it was executing online trades worth about $2.5 billion a day. A day. And this is the moment at which the outside world completely lost the ability to check anything at all. Because on Enron Online, Enron was on one side of every single trade that happened. It was not a marketplace where buyers found sellers and the operator took a fee. It was a counter, and Enron stood behind the counter. Which means Enron could see every price that every participant in the market wanted in real time, and no participant could see anything about Enron's own position. From the outside, all anybody could see was volume. Enormous, accelerating, genuinely hypnotic volume. And volume looks exactly like health, right up until the moment that it does not. This is worth naming properly, because it is one of the most reliable ways to be fooled by a business. Volume tells you how much is moving. It tells you nothing whatsoever about the margin on any of it, or about who ends up holding the risk when a trade goes wrong. A company can move $2.5 billion a day and lose money on every single unit of it, and from outside the two situations are indistinguishable. In January 2000, Enron announced it was entering the broadband business and created Enron Broadband Services. The internal logic was perfectly consistent. Bandwidth is a commodity. Commodities can be traded. Enron trades commodities. And honestly, it is not a stupid idea. Bandwidth trading was about a decade early, and it was attached to a company that was obliged to book the profit immediately. That combination is fatal, because an idea that is a decade early produces no cash for a decade. But the earnings from it had already been reported and spent. There is one project that shows the entire problem in a single physical object, and it sits about 9,000 miles from Houston. In 1992, India opened its power sector to foreign investment for the first time. Enron moved almost immediately. The project was called Dabhol in the state of Maharashtra on the west coast. Dabhol in the state of Maharashtra on the west coast, a power plant T. The joint venture was Enron with 80%, General Electric with 10%, and Bechtel with 10%. Construction began in April 1995. The plant was to cost $2.8 billion. It was described at the time as the largest foreign investment India had ever received. The contract was renegotiated. Construction stopped and started again. Phase 1 was completed in 1999, 4 years after the first ground was broken. Now hold the accounting up against the concrete and look at them together. The value of a 20-year power contract in Maharashtra could be estimated, discounted, and booked as profit in an office in Houston years before the plant produced a single unit of electricity. The estimate was reported to shareholders as earnings. The plant, at that point, was a hole in the ground and a set of drawings. And if the estimate turned out to be wrong, the earnings had already gone into bonuses, into the share price, into the confidence that funded the next deal. This is the thing to hold on to about Enron. Nobody needed to forge a document for any of that to happen. They needed a spreadsheet, a discount rate, and a considered professional view about the price of electricity in the year 2015. And a view about the price of electricity 20 years out is not a fact anybody can check. It is a forecast, and the only person who can grade it is the person who made it. So here is the position Enron is in by the end of the 1990s. It has reported enormous profits. It has not, in a great many cases, actually received the corresponding cash. It has bought things, stakes, ventures, half-built projects, and some of those things are now worth considerably less than it paid for them. And under mark-to-market, a fall in value is not a private disappointment you absorb quietly. It is a loss, and it lands in this quarter's accounts. The method that manufactured the profits on the way up manufactures the losses on the way down. It runs in both directions. It always did. That was the deal all along. And that is the problem the second move was built to solve. The second move is the special purpose entity. A special purpose entity is, in itself, a completely ordinary thing. You set up a separate legal company to hold one specific set of assets for one specific purpose, usually so it can be financed separately. Perfectly normal. Banks do it. Airlines do it. Property developers do it. It is how an enormous amount of large-scale financing gets done entirely respectably. The question that decides everything is whether that separate company shows up on your balance sheet or not. If it is genuinely separate, if there are outside investors carrying real risk in it, then it does not consolidate. Its debts are not your debts, and its losses are not your losses. And notice how much weight the word genuinely is carrying in that sentence. The entire question of whether an enormous amount of debt appears on a company's balance sheet or does not appear anywhere at all comes down to a judgment about how real somebody else's risk is. That is not a number. It is an argument, and arguments can be made well by people who are paid to make them. Enron built a set of these vehicles. The best known of them were nicknamed the Raptors. They were created under the Chief Financial Officer, Andrew Fastow, and their function was to absorb mark-to-market losses on Enron's own equity investments. Read that as plainly as it deserves. The company constructed vehicles whose job was to take the losses off the company's accounts. So Enron's reported profit stayed where the market expected it, while the value underneath it fell. And the partnerships that made this possible held very large amounts of debt that never appeared in Enron's own numbers at all. That is the second move. Debt parked inside an entity you control in practice but do not consolidate on paper. Two moves then. Profit booked today on a promise about tomorrow, and debt moved somewhere else, into something with a different name on the door. Neither of them is a lie in the way people expect a lie to look. Both of them are decisions about where a line is drawn, made by people who were paid to draw it, in documents that were filed publicly and were available to anybody who asked for them. And that is the thing that should genuinely unsettle you about this episode, rather than the size of the numbers. In August 2001, Jeff Skilling resigned as chief executive of Enron. He had been in the job for about 6 months. Kenneth Lay, who had run the company before him, stepped back in and took the role again. I am not going to tell you what was in anybody's head that month, because nobody can, and the court record does not establish it. What I can tell you is what the market did with it, which was not very much, not at first. Chief executives leave companies. The company says it was a personal decision. The share price wobbles for a fortnight and then recovers, and everybody moves on. The number that could not be waved away was still 2 months out. In October 2001, Enron reported a third quarter loss of $638 million. What? And in the same disclosure, a reduction in shareholder equity of $1.2 billion. Those two numbers are not the same kind of thing at all, and the second one is the one that ended the company. A quarterly loss is a bad quarter. Enormous companies have bad quarters. A bad quarter is survivable, and everybody knows it. But a $1.2 billion reduction in shareholder equity is the company standing up and saying, the value we have been telling you is inside this business is not inside this business. And it was tied, in part, to the partnerships run by Fastow, the ones holding debt that had not been appearing in Enron's numbers. So the disclosure was not simply that money was missing, it was that the place the money had been hidden now had a name, and the name was in the filing. From that point on, the questions stop being about earnings and start being about structure. And structure is the one thing a company cannot restate its way out of in a fortnight. Because everything Enron did rested on three things: on being able to borrow, on counterparties being willing to trade with it, and on a credit rating. And every single one of those three is made out of confidence. Once a market decides that it cannot see inside your balance sheet, it does not wait politely to find out what is on it. It leaves. Counterparties stop trading with you first because they are the ones who lose money if you fail overnight. Then the rating goes, and once the rating goes, the borrowing that the whole structure was resting on simply stops being available at any price. On the 2nd of December 2001, Enron filed for Chapter 11 bankruptcy. At that moment, it was the largest corporate bankruptcy in the history of the United States, roughly 6 weeks from the October disclosure to the filing. A company with 37,000 miles of pipeline in the ground. And the pipe did not go anywhere. It is still there. Gas still moves through a great deal of it to this day under other names. What collapsed was not the physical business. What collapsed was everything that had been stacked on top of the physical business. And that is the honest shape of the Enron story, the shape that survives fact-checking once you take away the cartoon. A real company with real assets, doing real business, which adopted a way of counting that let it report the future as though it had already happened, and then could not stop. Could not stop, specifically because once you have booked next decade's profit into this quarter, the only way to show growth next quarter is to book the decade after that. There is no gentle way down from it. The method does not have a reverse gear, and everybody involved works that out far too late to do anything about it. There is a second collapse inside this story, and it carries the clearest lesson in the whole episode about who actually pays. Enron's auditor was Arthur Andersen, one of the largest accounting firms in the world. Andersen was convicted of obstruction of justice over the shredding of documents for instructing employees in a way that hindered the investigation into the firm's own role at Enron. The firm did not survive the conviction. Clients left, partners left, staff left. In 2005, the Supreme Court of the United States overturned that conviction, by which point there was almost nothing left for the ruling to be of any use to. The firm was gone. The people who had worked there had lost their jobs years earlier over a conviction that no longer stood. That is worth sitting with for a moment. The legal system corrected itself exactly as it is supposed to. It corrected itself far too late to help anybody it had been wrong about. And notice carefully what the ruling did not say. It did not say the shredding had been fine. It said that the conviction could not stand in the way it had been reached. Those are very different sentences, and the difference is most of what people get wrong about this part. Now, the criminal cases, and I am going to be exact about these because this is where retellings go soft and start rounding things off. Jeffrey Skilling was convicted on 19 counts of securities and wire fraud. He was sentenced to more than 24 years in prison. In 2009, an appeals court vacated that sentence on the ground that a sentencing guideline had been improperly applied. In June 2013, he was resentenced 14 years. Kenneth Lay was convicted on all 6 of the counts on which he was tried. He died in July 2006 before he was ever sentenced. Andrew Fastow, the chief financial officer, was indicted on 98 counts of criminal misconduct. He pleaded guilty to 2 counts of conspiracy, agreed to testify against Lay and Skilling, and served 6 years. 98 counts reduced to 2 in exchange for the testimony that made the cases against the other 2 possible. That is not a scandal in itself. It is how large financial prosecutions are actually built, almost always. But you should know that it is how they are built, because nobody says it out loud. And now look hard at what the convictions were actually for. Securities fraud, wire fraud, conspiracy. Not using mark-to-market accounting, not creating special purpose entities. Neither of those appears anywhere in any of it. The methods were never the crime. What was prosecuted was what was said to investors about them, which is exactly why both methods are still in use this quarter in companies you own a piece of. So, what did it cost and who paid it? Those are 2 different questions, and the second one is the one that matters. Roughly 5,000 people lost their jobs. About $2 billion in employee pensions was lost. And roughly $50 billion of Enron stock became worthless. I want to hold those 3 numbers apart because they are not distributed in remotely the same way. The $50 billion was spread right across the market. Funds, institutions, index holders, individuals. Painful, very wide, and survivable for almost everyone it touched. The $2 billion in pensions was not spread across anything. It sat underneath about 5,000 specific households, and it did not move. Those were people whose salary and whose retirement were both attached to the same estimate of the price of gas in the year 2015. And they had no way on earth to check that estimate because the estimate was the company's own opinion about its own future. That is the part of a fraud that never turns up in the accounting, and it is the part that lasts the longest by a very wide margin. The restatements were finished years ago. The court cases are finished. The pensions were not restored by any of it. Right? What do you actually take away from this and use on a Tuesday on a real company? 3 things, and all 3 still work, precisely because none of the machinery was outlawed afterwards. 1. Go looking for profit that is recognized today on cash that arrives over decades. You find it by putting reported profit next to cash flow from operations over several years, not over 1. 1 year tells you nothing, 5 years tells you everything. If reported profit keeps climbing and operating cash flow does not follow it up, you are not looking at money. You are looking at estimates. That single comparison, done once a year on a Sunday afternoon, would have shown you Enron. It is 2 lines from 2 statements that are printed in every annual report, and you do not need to understand a single thing about gas to read it. 2. Go looking for debt that belongs to something with a different name on the door. Read the notes to the accounts, not the headline statements. Look for related entities, joint ventures, partnerships, off-balance sheet guarantees. If a company clearly controls something in practice but does not consolidate it, ask what is inside it. That question on its own is the whole of the second move. And if the notes are hard to follow, that is information too. Genuinely simple arrangements are usually described simply because there is no reason to do otherwise. 3. Ask who produces the estimate and what happens to that person if the estimate is optimistic. Not whether they are an honest person. Almost everybody is. Ask whether the structure they work inside makes optimism the sensible thing to do. At Enron, a signature on a Friday was earnings by Friday afternoon. Nothing about that arrangement required anybody in the building to be a criminal. It only required a large number of ordinary people to keep doing the thing that the structure around them was rewarding, which is what large numbers of ordinary people reliably do. And one more, free, which is not about accounts at all. When a market decides it cannot see inside a company, it does not wait for the facts to come in. It leaves 6 weeks from the disclosure to the bankruptcy. The reason Enron is still the case that everybody names, 25 years on, is not the size of it. Bigger things have failed since. It is that nearly every step of it was visible at the time in public filings that anybody could order, and it still took years and a bankruptcy before a single person was convicted. The documents were not hidden, the reading was hard, and almost nobody did the reading. You can do that reading on any company you own a piece of. In an afternoon, profit against operating cash flow, then the notes. Which is the genuinely uncomfortable version of this story. Not that everybody was deceived, that the information was sitting there and the incentive to actually read it was not. The regulator declined to object in 1992. The auditor signed, the rating agencies rated, the analysts recommended, and every one of those was a competent person doing a job that did not reward asking the next question. So ask yourself, on the next set of accounts you open, who in that chain was actually paid to ask it? Next Saturday on The Great Frauds, we go back nearly 300 years to a Scotsman who talked an entire kingdom into a scheme built on land that almost none of them had ever seen. John Law and the Mississippi Bubble, the fraud that wrecked the finances of France. And if the two moves were useful to you, tell me in the comments which set of accounts you are going to try them on first. I read them, I answer them, and I will see you next Saturday.